Good morning, everybody. Welcome to Unraveling the Mystery of 1031 Exchange Transactions. And this is brought to you by the North San Diego County Board of Realtors. And happy to be here and happy to have all of you here. One of my goals is to kind of walk through what really matters, what really qualifies for 1031 exchange transactions. And that's why I named this Unraveling the Mystery, because there's lots of opinions out there. And you get all these opinions and people say, well, I talked to three or four people. I got three or four different answers. I'm really confused. What really matters? And so this is how you could bring more value to your clients by knowing what really counts, what really qualifies. So as we're going through the program, I'm going to point out, especially the real critical slides, why and where there's misinformation or varying opinions, and then really address what really matters. And then you can help your clients as they go through that. So that's my QR code. If you want to scan that, we've got a bunch of links to our educational material, including our guide to 1031 exchanges. That's about a 30-page guide that walks through all of what really matters, what really qualifies. And it's really great for clients who want to go through and get up to speed quickly on how the 1031 works, what they have to watch out for, and things like that. And for those who haven't worked with us before, my name is Bill Exeter. I'm the CEO of Exeter 1031 Exchange Services and Exeter Trust Company. And Exeter 1031 Exchange Services is a qualified intermediary. A lot of clients will refer to them as an accommodator or a facilitator. It all means the same thing. And we're also an exchange accommodation title holder. And that means that when we have to acquire and hold, or what the IRS calls park, legal title to real estate on behalf of a more complicated 1031 exchange, which is typically a reverse or an improvement 1031 exchange, we can handle that as well. So we administer all types of 1031 exchange transactions in all 50 states. That includes the U.S. territories. It also includes foreign properties or foreign countries. And that's the first area of misinformation out there on the internet, if you will. A lot of things you read will say things like you cannot 1031 exchange foreign properties. That's not true. What they're really trying to say is you cannot sell a foreign property and then 1031 exchange into a U.S. property, and you can't sell a U.S. property and 1031 exchange into a foreign property. So each 1031 exchange either has to be all U.S. properties or all foreign properties. So to kind of expand on that, when I say we administer all types of 1031 exchanges, that means it includes forward 1031 exchanges. And we'll talk mostly about that because 97% of the transaction volume are forward 1031 exchanges. And people call them all sorts of things: forward 1031 exchanges, delayed exchanges, like-kind exchanges. Those who've been around a long time, like me, might refer to them as a Starker exchange after the family that really took on the IRS and set the precedent for today's 1031 exchange. But they all mean the same thing. They are selling their current relinquished property first and then reinvesting in replacement property later. So most people do forward 1031 exchanges. When they get into a case where they have to acquire and actually close on the purchase of their new replacement property first before they sell their current property, then they have to look at doing a reverse 1031 exchange. And the reverse 1031 exchange means that there's no deadlines up front. They can work with you and spend all the time they want to find the right replacement properties to meet their goals and objectives, whatever that means. In a lot of cases, they might end up buying 2 or 3 replacement properties. So it's a great way for you to generate more business for yourself. And then once they close on that, we have to take legal title to the properties they're buying. It's what the IRS calls parking title. The IRS doesn't allow the taxpayer to buy and own both the relinquished property and also the replacement property at the same time. So they treat it as 2 separate transactions where you currently own the property you want to sell, and the property that you're buying has to be acquired and held or parked by the qualified intermediary, which is our job. So that gets a lot more complicated. There's a lot more documentation, a lot more moving parts. We have to hold legal title, which can complicate other things. Probably the biggest thing that complicates is lenders. Traditional lenders who want to make a loan package it into a pool and sell it to an investor pool probably won't touch a reverse 1031 exchange. There are ways we could take title to the current property, but so what we have to do really is get you and the client and us all on a conference call, walk through the goals and objectives, and then find out what strategy and what structure of a reverse exchange makes sense. But the reverse exchange does let them close on the purchase of their new property or properties first, and then they sell their current property after the fact. So that really is a great tool for today's market. They don't have to worry about whether or not they can go out and find property. They actually can go out and close on it, so they know they've got it, and it's a lot safer that way. But all the complexities come into play there. So that's why it's only 4%, maybe 3% of the transaction volume, depending on the year. Actually, this year and the late last year, it was almost 5% of the transaction volume. So because of the high interest rates and the tight market and all of those issues, reverse exchanges have almost doubled in volume since a year and a half, 2 years ago. The improvement 1031 exchange, you won't see a whole lot of, especially here in California. The improvement exchange means that the client is selling real estate. They use some of the sale proceeds to buy property, and they have excess proceeds left over, and they use that to make capital improvements to the property they're buying. Now, in California, getting a permit in that 6-month window is almost impossible. In some cases, is impossible. So you won't see a whole lot of improvement 1031 exchanges because we have to acquire and hold, or what they call park legal title, to the new replacement property. And then they have the rest of their 180-day exchange period to finish all of the improvements that they want to do as part of the 1031 exchange. So just to get permits and then get the construction completed within that 6-month window is, in a lot of cases, impossible. But we do probably 2 or 3 of those a month, so it is doable in certain cases. The zero equity 1031 exchange, you generally don't hear a whole lot about. Zero equity doesn't really apply today, perhaps, maybe in a few cases, but it's really when you go into a recession, you've got a client who bought property a long time ago. They keep refinancing every year or two and pull equity out. So maybe they bought it for $100,000. Maybe today it's worth $1 million. They financed and financed and financed over time so that their debt is maybe $900,000. And then a recession hits and the value of the property drops. Maybe it drops to $600,000 or $700,000. They look at it and go, I owe the bank more than what the property is worth. If they end up in a foreclosure or a short sale or something like that, a lot of times the client thinks, oh, I have no equity. I'm going to pay everything to the bank. I get nothing out of it, so I have no tax consequence. Well, that's not true. They bought the property for $100,000. Today it's worth $1 million. It drops in value to $600,000 or $700,000. When the recession hits, they bought it for $100,000. They still have $500,000, $600,000, or maybe a $700,000 taxable gain, even though they have no equity. So that's a zero equity 1031 exchange. It is still possible to do a 1031 exchange when they owe the bank more than what the property is worth. So that's kind of a quick overview of the different types of exchanges. We're going to go into a lot more detail on the forward 1031 exchange, since that's really the big transaction volume. So again, it does apply to real property. It does not apply to non-real estate, or what legally is referred to as personal property. Personal property doesn't qualify. And again, foreign property does qualify as long as you're selling foreign property and then buying foreign property. One of the important things to know about the 1031 exchange qualified intermediary industry, and this is critical, most investors don't even know this, and they're shocked when they find out. Our industry is not licensed, it's not regulated, there is no regulatory capability. So 99% of qualified intermediaries out there have no regulatory oversight, they have no audit or exams or anything like that. And there's essentially no requirement for insurance, bonding, and things like that. So we decided, as we came out of the 2008 recession, we thought, if we want to take our business to the next level and better protect our clients, we need to be licensed and we need to be regulated. And since the industry doesn't have that capability, we had to go down the banking path. So we decided to go down the banking path, and I'll get into that in just a minute. But we now are licensed and regulated through a trust company. And that means we are one of the few 1031 exchange qualified intermediaries that has any government or regulatory oversight, and that is critical. I've been doing this for 41 years and actually almost 42 years. That's kind of scary when I think about it. Um, and all the failures that I have seen during those 41, 42 years is, they would have been avoided had there been regulatory oversight with regulatory exams, et cetera. So it is critical to work with a regulated entity just to protect you, especially. You don't want the client to come back and say, you referred me to this company and they went out of business, because then they sue everybody. So you want to work with a regulated, qualified intermediary, and that's critical. So again, this is my 41st, 42nd year. Exeter 1031 Exchange, we set up the Exeter Group 21 years ago, and Exeter 1031 launched 20 years ago. So we're just now celebrating our 20th anniversary. We're more consultative and advisory, so we really try to work with you and your clients. We can jump on a conference call, we can meet in person, walk the client through their requirements, their goals, their objectives, how to structure the 1031 exchange. These are confusing transactions. They're complicated. So our job is to walk them through the whole process, and most importantly, answer questions, because it's going to trigger lots of questions. So that's critical. And I mentioned we're regulated. So we took a couple of years of going through the regulatory review and approval process to end up with our own trust company charter. So we launched Exeter Trust Company. We got our charter in March of 2019, and that's Exeter Trust Company. And it's licensed, regulated, and audited by the Wyoming Division of Banking. We chose Wyoming for a lot of different reasons. Most of which is they are great for business relationships. The regulatory environment is very regulatory friendly, and they have different trust products that other states don't have, so it makes sense for our clients. And that also means that we have $10 million of fidelity bond coverage, $10 million of errors and omissions insurance. I forgot to list it here, but we also have cyber fraud and wire transfer fraud insurance. That is critical today. That's probably the biggest risk nowadays. And then launching the trust company gave us the ability to roll out other products. So we can do self-directed IRAs and 401ks. So if you have a client who wants to use their IRA or their 401k plan to buy real estate or invest in a deed of trust or a mortgage or tax lien certificates or invest in a private entity, private equity, we can do that as the IRA custodian. So the client would choose what to buy, what to invest, and it's done through a self-directed IRA. And then we do other things like title holding trusts. When your client might want to negotiate, acquire, and hold real estate confidentially, they can do it through a land trust. We are the trustee of the trust. We show up on the public record, not the client. And then anytime you have a client who has a specialty holding escrow need, we can take a look at that. So that's kind of a quick overview of who we are. The first thing I thought I'd point out is how to protect yourself. We do a lot of expert witness work, and one of the things we've found in the last, say, 10 years or so is when an exchange goes bad, the attorneys call and say, whose fault is it? One of the biggest areas is they'll say, my client sold real estate. It was rental property or investment property, and they then reinvested in other rental or investment property. Nobody told them about a 1031 exchange transaction, so they had to pay tax. And then they say, but nobody told us. So whose fault is it? Who should have told us? Well, the answer to that is easy. They should have gone to their tax advisor, their CPA, or their accountant, and their accountant should have said, you need to do a 1031 exchange. But as you and I know, they never go to their advisors, so it doesn't happen. And they're looking for people to blame. So if you're working with a client that is involved with any kind of a rental property, investment property, property used in their business, shoot them an email and say, have you talked to anyone about a 1031 exchange transaction? That way you have proof that you brought that up, and you can make sure that you can say, I did tell you, you just chose not to do anything about it. So just a little disclaimer there for yourself to kind of protect you, because attorneys are asking the question, who can we blame? And it's like, well, blame the client. And having said that, let's dive into the mechanical process of a 1031 exchange. For those who haven't worked with it before, it's under Section 1031 of the Internal Revenue Code. That's where it gets its name, 1031 exchanges. A lot of people will refer to it as a tax-free exchange. It's not tax-free, it's tax-deferred. So it's important to remember that. Make sure clients know they are deferring the payment of their capital gain taxes and their depreciation recapture taxes, but it's only deferred. Now, there are ways it can become tax-free. We'll talk about those kind of toward the end of the webinar. But in most cases, it's tax deferred. So the first thing for clients to know is anytime they are selling rental property, investment property, or property used in the business, it's probably going to trigger a taxable gain. And the taxable gain could include capital gains, which is growth in value. It could include depreciation recapture. When your clients own real estate that's rental or investment property for a number of years, every year they get to take a depreciation deduction on their tax return. They get to write off part of the value of the property on their taxes. That's depreciation. If they just sell the property and that's it, they don't do a 1031 exchange, all of that depreciation they've taken over the years is added back to their income and taxable, and people call it depreciation recapture. But the 1031 exchange allows them to defer all of that. So at the end of the day, the real benefit here is the 1031 exchange allows them to sell their current property and then reinvest in other rental, investment, or business use properties and defer the payment of all those taxes. They don't pay any capital gain taxes. They don't pay any depreciation recapture taxes, and they can avoid the net investment income tax, or people call it the Obamacare tax or the Medicare surcharge. That's the 3.8% tax that you hear people talk about. That they avoid that, or they don't trigger that because they've deferred all of their taxable gain. So it really keeps all of their money, all their equity in their pocket, and it makes it a lot easier for them to reinvest in typically larger properties or more properties than what they had. And from your perspective as a licensed agent, it gives you the ability to drum up more business because they sell one, they have to buy at least one. And a lot of clients will buy 2 or 3 properties. So it's a great way to get out there, talk to investors, talk about 1031 exchanges, and probably generate at least 2, if not 3 or 4 transactions for you. So it's a great business development tool. So as I said, the big benefit is deferring the taxes. Clients will ask us a lot, well, what's the best way to take advantage of that? And it's really exchanging throughout the lifetime. It's not, clients look at it as a transaction tool. I'm selling, I don't want to pay tax. I want to defer the tax, and I just use it as a transaction tool. So I sell, I exchange, and I reinvest, and it's done. But it's really a lot more than that. It's a wealth building tool where they can continually do 1031 exchanges over and over and over throughout their lifetime. Every time they sell a rental property, they do a 1031 exchange into another rental property or multiple rental properties. And by doing that, it builds their wealth much faster because all the money they would have paid to the federal and state governments in taxes stays in their pocket, gets reinvested, and they can earn money on that money. So it's a great wealth building strategy over time. Now, the big benefit is when they pass and they leave the properties they have to maybe their kids or grandkids or friends or whoever inherits that property is going to get what's called a step up in cost basis. So let's just say years ago they bought property for $100,000. Today it's worth $1 million. Let's say it's me. Let's say I pass. I'm going to leave it to my wife or my daughter. They're going to get a step up in cost basis. Their cost basis is increased or stepped up to the $1 million, which is the fair market value at the date of my death. And that's what their cost basis is. They could sell the property the next day for $1 million. Their cost basis is $1 million and they pay 0 taxes. So that's really the best way is keep exchanging. That way you keep building wealth. From your perspective, it keeps a client in your back pocket. The client keeps coming back every few years to do another exchange. They sell more property, they buy more property. And then when they pass on, whoever they leave the property to gets that step up. So the easiest way to remember that is what we call swap until you drop. We have a morbid sense of humor, so keep swapping until you drop, and then that keeps all the money in their pocket, and then they get that step up. And I forgot to mention at the very beginning, happy to take questions as we go. So if anything I say triggers a question, feel free to interrupt and we can take the question verbally, or if you want to post it, we can post it in the chat function. Just go ahead and enter the chat, and I'll keep an eye on the chat to see if there's any questions coming. So we've kind of talked about the structures and strategies already. And that is the forward 1031 exchange, the reverse 1031 exchange, and the improvement 1031 exchange. So the forward 1031 exchange is, about 96, 97% of the transaction volume. Most of them are delayed exchanges. They sell first and they buy second, and they close on the purchase somewhere within that 180-day window, which we'll talk more about. But you could also close simultaneously. So if they could sell and purchase and close both on the same day, that would certainly work. It's a simultaneous or concurrent 1031 exchange. But in almost, I'd say 99.9% of the cases, they're going to close on the sale, and then somewhere after that fact, but within that 180-day window, they'll close on the purchase. Reverse exchanges are the opposite, as we talked about. And we talked about that parking arrangement. That's why it gets so complicated. Although from my perspective, if I'm doing a 1031 exchange, I'm going to try really hard to do the reverse 1031 exchange because it takes a lot of the risk out of the 1031 exchange process. You and your clients can go find the property they want and close on it, and then you've got the property. So now all you have to do is worry about selling the current property. The big issue there, though, of course, is you're buying first. They haven't sold yet. There's no equity available. So the question is, how do they pay for the replacement property? Now, if the client's in a position where they can pay all cash, great. It's complicated, but very doable. If there's a lender involved, we usually jump on a phone call with the lender to see if the lender will play ball. If not, we might have to work with like a hard money, private money, bridge financing. Credit unions are really good. Life insurance lenders are really good. So there's options out there. We just have to kind of talk about that. And then we talked about the improvement exchanges, which are really difficult, especially in the California marketplace. Okay, we talked a little bit about the 1031 exchange when I was introducing our company to you. The most important part, and this again helps protect you, is that anytime you're working with with a client that has rental, investment, or business use property, make sure I wouldn't do it verbally, I would do it by email or both, but make sure you've notified them, hey, you're working with rental, investment, or business use. Have you spoken to anyone about a 1031 exchange? The most important thing is they have to set up the 1031 exchange with a qualified intermediary. And again, that's our role before any of the properties close escrow. And that's critical. The reason for that is the purchase and sale agreement is assigned to us as the qualified intermediary. We literally step in their shoes. We become the seller, and that's what allows them to defer the taxes. If the sale property or the sale transaction closes without a 1031 exchange in place, then it becomes a taxable event. There's no way to go back and fix it. Once the closing occurs, if the 1031 is not in place, the client has the right to receive the funds. So even if they tell escrow, don't disperse the funds, I'm going to do a 1031 exchange, they still have the right to receive the funds, and it's taxable. So the 1031 has to be in place before closing. And the role of the qualified intermediary is three things. We prepare documents to structure the 1031 exchange transaction. We're going to receive and hold and safeguard the 1031 exchange funds. And again, we talked about the fact that it's critical that the client use a regulated qualified intermediary. That is critical. And third, we're really a sounding board. They can call us. You guys could call us, brainstorm, bounce ideas off of us. We could talk about structures, strategies, all sorts of things, because all sorts of things come up in transactions. For example, today, one of the big questions we're getting a lot of is, what if I sell property with 10, 20, 30% cash down and then a seller carryback note? Can that be done? And most people will tell you, you can't do that with a 1031 exchange. It's possible. It can be done, but it's complicated. So that's one of those things where we jump on a call, try to find out what's going on, and then we'll give you advice on how we can structure that, how it would work, and how it would not work. What happens if we can't pull it off? So that's critical to be able to bounce ideas off of us like that. So we're a lot more consultative than most qualified intermediaries, and that's a critical thing. The one thing that a lot of qualified intermediaries don't talk about is, how does the client protect their funds? How do you safeguard the client's funds? So again, we've talked about regulatory oversight. That's critical. Regulatory oversight means, well, at least in our case, it means three things. We have an annual regulatory exam, and I'll tell you, regulators dive deep. Number two, we do an annual financial statement review by our certified public accounting firm. So it's an independent outside CPA firm that comes in and audits our financial statements to make sure that we're operating in a safe and sound manner. And then we've chosen to add a second CPA exam, and this CPA exam audits our policies and procedures to make sure we're following what we say we do and make sure that we're operating as a best practices qualified intermediary. So all of that is critical to protect your clients from misappropriation of funds, theft, fraud, etc. Second, you want to make sure the qualified intermediary has insurance. Everyone focuses on fidelity bond coverage. That's critical. That's crime insurance, theft of funds, etc. So that's important. But most people are, well, I mean, we're all human, so most people are going to make mistakes occasionally. And when the mistake is a big one, you want to make sure there's errors and omissions insurance to cover it. And a lot of companies either have no E&O insurance because it's very expensive, or if they do, it's 100,000 or 250,000, which is nothing in today's world. So we have a $10 million errors and omissions insurance, a $10 million fidelity bond coverage. And then you want to make sure they also have cyber fraud and wire transfer fraud insurance, because that's the big risk today. We've had numerous clients who have had their emails hacked and they've experienced losses because they didn't call and verify the information. So it's critical. In our case, we call and verify every single set of wire transfer instructions before we send it, no matter what size the wire is, even if it's for $100, to make sure that it is a legitimate wire transfer instruction provided to us by the escrow or by the client, etc. And finally, you want to make sure the funds are held in qualified trust accounts, or it could be a qualified escrow account. For those of you who've been around long enough, like I have, back in 2008, Land America, which was the third largest title insurance company in the country, and also obviously third largest escrow company, one of the largest qualified intermediaries, they failed because they invested funds in auction rate securities. Those are not necessarily bad investments, but they're not good for escrow funds or 1031 exchange funds. And when the 2008 recession hit, the auction rate securities market froze. They couldn't get the money out. So they had to use incoming client funds to pay outgoing client funds. When the market got worse, they had to put corporate capital in to pay for outgoing funds, and they ran out of corporate capital. So they were forced into bankruptcy. The judge ruled the funds were subject to the creditors in the bankruptcy estate. Effectively, that means they were corporate funds, not client trust funds, because they were not held in a qualified trust account. So, and he also said if they were held in a qualified trust account, like the Treasury regulations allow, his ruling would have been different. So it's critical. Those are really the three most important things to look at when you're looking at qualified intermediaries: government regulatory oversight, bonding, insurance, and the qualified trust account. Okay, this is probably the most important slide of the slide deck, and that's qualified use property. This is also where there's a lot of opinions out there, and this is where there's the most confusion out there. So this is where you can help bring clarity to your clients. So qualified use means that when they're doing a 1031 exchange, the properties they are selling and the properties they're buying through the 1031 exchange have to be held for qualified use. And it's the intent that matters. The intent is critical. Do they intend to hold these properties for rental, investment, or business use, or do they intend to do something else? And that's the critical part. So let's kind of dive deep there, and then I'll take a few questions. So again, it's all about intent. The intent has to be held for rental, investment, or business use. So let me talk about those real quick. A lot of what you see on the internet out there will say the properties have to be held as rental properties. That's not completely true. They mean well, but it's not completely true. So certainly if you are holding property and it's a rental property, or you're leasing it out and you're collecting rental or lease income, it qualifies. It's got cash flow, it's an income property, etc. But it doesn't have to produce cash flow. You could buy real estate and hold it for capital appreciation. Probably the best example is a client who sells maybe a single family home and then buys a large tract of dirt, land, and there's no improvements on it. They just buy dirt, and then they hold it for capital appreciation. So maybe 5 years later, a developer approaches them and says, hey, I'd like to buy your land. They sell it, they make a nice profit there. So that would qualify. It doesn't have to produce any kind of cash flow. Sometimes they'll buy dirt and they'll rent it to either rancher or farmer, maybe for cattle or something like that. That produces rental income, that qualifies, but it doesn't have to. It could just be held for capital appreciation. Or you could actually buy property and use it in your business. So, for example, you folks might buy a little office building for your realtor business, or maybe you use one or two of your bedrooms in the house for your real estate business. That's considered business use. So, part of the house could be considered a rental property or business use property. So, certainly those type of opportunities work and they qualify. Those investors who buy real estate to do something to the property and then turn around and sell it, they're not holding for investment, they're holding for sale. So investors who are like rehabbers, flippers, builders, developers, condo conversion specialists, wholesalers, things like that, they typically buy the property, do something to the property, and then sell it. So they're holding for sale. It's like inventory in their real estate business, and it doesn't qualify for 1031 exchange treatment. Now, if they were to buy the property, do something to it and actually hold it, then it could qualify. So it's you can see there's a little gray area there in terms of what matters, what qualifies. But the real issue is what was your intent? So a couple of examples. There's two tax court cases. In both cases, they were developers. They bought dirt. Their intention was to build single family homes and then sell. So their intent was to buy, build, and sell. In these two cases, neither one built anything. They both bought the dirt and they held the dirt. One held the dirt for 12 years, the other held the dirt for 20 years. In both cases, they ended up selling the dirt without building. They both did 1031 exchanges. They both got audited, and both of their 1031 exchanges were disallowed. And the reason for that, which shocked the industry, because they're like, God, it was 12 and 20-year holding period. But the reason for that is the intent was to buy, build, and sell. They were holding as inventory for sale. They were not holding for investment. Now, had everything changed, let's say the real estate market changed, which it obviously does all the time, or their business model changed, or COVID-19 changed a lot of things for a lot of people. So if they had said, you know what, we're no longer going to build, we're going to hold this for capital appreciation, and then somewhere in the future we're going to sell, and if they change the way they document that, so on their tax returns, change it from held for development to held for investment, on financial statements, tax returns, loan applications, emails back and forth between you and the clients, or their tax attorney, their tax accountant, what have you. Anything like that that can be used to document their intent has changed. Now we're holding for investment. Those 1031 exchange transactions would have qualified. On the flip side, we had one of our clients years ago do a 1031 exchange, bought a condo on Coronado Island, didn't read the CC&Rs until after closing, and within a day or two after closing, quickly found out the property had to be owner occupied. It could not be rented out. So he immediately sold at another exchange. He was audited by the California Franchise Tax Board. They allowed his 1031 exchange to qualify because he could show his intent was to hold for rental purposes, but there was a business reason why he couldn't. And that's why he did another 1031 exchange. Now, I wouldn't push the Franchise Tax Board that hard unless you have to. They're a little nasty with some of these things. So be careful with the Franchise Tax Board. But that shows you that a 45-day, he held that property for about a month and a half before he sold it again. A month and a half holding period can qualify as long as you can prove intent. So that's what it boils down to. So the holding period is not the deciding factor. And a lot of people will tell people or tell you, or on the internet, you'll see stuff that says you have to hold the property for at least a year and a day, 18 months, 24 months. More and more people are starting to say you got to hold it for 2 years. Those are opinions. The tax code, the tax regulations, nothing says you have to hold the property for a certain period of time. All it says is you have to have the intent to hold for rental, investment, or business use. Now, the reason people get hung up on the length of time is the longer you hold the property as rental or as a business use or what have you, the easier it is to prove and show your intent was to hold it for the qualified use. The shorter the holding period, the more difficult it is to prove that you had the intent to hold it. But again, the holding period does not decide whether you had the intent to hold for qualified use, but the holding period certainly helps prove intent. So that's really the name of the game there. And one of the questions here is, does Exeter conduct business to business stock and or asset exchanges, merger acquisition transactions? With the 1031 exchange code, the only asset or only transaction that qualifies is real estate to real estate. So it has to be a real estate sold, real estate purchase. So anything that qualifies as real estate will work. And that is a perfect lead into the next slide. And that is like-kind property. And there's a lot of stuff out there on the internet where people say if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. Absolutely not true. Like-kind is very simple. Like-kind means you have to sell real estate and then reinvest or buy real estate. That is all it means. So as long as what you're selling and buying is real estate, it will satisfy the like-kind requirement for a 1031 exchange. So then what really matters is that real estate held for rental, investment, or business use, and can you show that? So that's what like-kind is all about. That's the critical part. Anything that is not real estate, so business interests, like an LLC, a corporation, if you're selling stock of the corporation, if you're selling furniture, equipment, if you're selling an aircraft, things like that, none of those are considered real property, so it won't qualify for 1031 exchange treatment. It does have to be real estate for real estate. And also, as we talked about, the one limitation with like-kind is it does have to be U.S. property for other U.S. property or foreign property for other foreign property. That's really the only requirement in terms of like-kind property. Everything else is wide open as long as you are selling real estate and buying real estate. And again, personal property, which means non-real estate, no longer qualifies for 1031 exchange treatment. And one of the questions is, does Exeter conduct a 721 exchange? Yes, we do. Let me dive a little deeper there. So a 721 exchange, people call them all sorts of things. In most cases, it's either referred to as a 721 exchange. It could be referred to as a 1031/721 exchange. Sometimes you'll hear it referred to as an UPREIT, that's UPREIT, which is Umbrella Partnership Real Estate Investment Trust. Effectively, it's a two-step process in most cases. The two-step process is this. Your client would sell real estate, structure a 1031 exchange. Instead of going out and buying their own property, they're going to buy a Delaware Statutory trust, and most people buy a percentage, like a 0.25% interest or a 0.5% interest in the Delaware Statutory Trust, which I'm going to talk more about. That Delaware Statutory Trust will exist for usually 2 years or so. And the reason for that 2-year period is to prove they had the intent to buy and hold for investment purposes. And then usually at the 2-year mark, the sponsor will take that Delaware Statutory Trust and contribute that property into the umbrella partnership, which is part of the REIT. So now the second step is the 721 contribution. That contribution of the real estate into the umbrella partnership is the 721 contribution. So it's really a 1031 exchange up front, followed by a 721 contribution into a partnership. Now the investor is technically inside the real estate investment trust, and they qualify for all the income in the entire REIT. They get the diversification, the cash flow of the REIT, etc. There is one big negative that you have to watch. Well, two big negatives, actually. The first one is now you're inside a REIT. So that's considered a security. It's no longer considered real estate from the investor's perspective. If they want a 1031 exchange in the future, they can't do that anymore because now they own effectively shares or units in the umbrella partnership or the REIT. But a lot of investors who go into the UPREIT or the 721 do it on purpose, and they don't care about a future 1031 exchange. But just so you know that, it no longer qualifies for a 1031 exchange transaction. Second, which is the big negative, is once you're in that umbrella partnership, if the sponsor sells that property that's held in the umbrella partnership, and they don't do a 1031 exchange, they just sell it outright, that will trigger all of the investors' gains who are in that partnership. So when you're looking at a 721, you want to read the private placement memorandum, the PPM, go into a lot of detail. I mean, it's horrible reading. It's 300 pages of legal stuff. But you want to read through it and find out if the sponsor could sell property without doing a 1031 exchange, because that would be a big surprise if they triggered your gain. So that's critical. So going back to the question, yes, we can handle the 1031 exchange part of that overall transaction, and then the 721 part would be handled by the sponsor. Usually these particular programs are set up specifically to start with the sale, a 1031, and go into the 721 and become part of the REIT. It's all pre-planned to do that. So that was probably an extra long-winded answer, but yes, we could do the 721s. The actual Delaware Statutory Trust, we don't sell those. We don't want to get compensated on any replacement property possibilities. We want the client to know all we do is the 1031 exchange. We're not trying to get compensated on the back end. So those are sold through boutique securities firms. We could certainly introduce you to people who do those if that's of an interest. And I'll talk more about that in a little bit. Kind of going back to like-kind real estate. So this is a quick list of what's like-kind property. So all of these are considered like-kind to each other. You could sell and exchange between all of these. We have done exchanges on all sorts of assets you wouldn't even think of. I mean, mineral rights, water rights, air rights. We've done exchanges on vineyards and timberland and billboards and cell site towers. What am I forgetting? All sorts of things out there that you wouldn't even think of would qualify for 1031 exchange treatment. As long as state law defines the interest to be real estate, it qualifies for 1031 exchange treatment. Also, you'll notice it includes fractional ownership interests. So that's your tenant in common investment property where you buy a 5% or 10% or you buy a percentage interest in the property as a tenant in common with other investors. That fractional purchase qualifies as a purchase of real estate for 1031 exchange treatment. The other and probably more common by far fractional ownership is the Delaware Statutory Trust. And I'll kind of cover that real quick. A lot of folks haven't heard of the Delaware Statutory Trust. The reason for that is they are securities. The IRS came out, I should back up. It's the way they're packaged, the way they're sold. And so they have been labeled as a security because of the way they're sold to investors. However, the IRS has come out with a ruling back in 2004. So we've got 22 years now after the ruling. And the ruling says, yes, they are securities, but for tax purposes, they are considered to be real estate and they do qualify for 1031 exchange treatment. So a Delaware Statutory Trust, or DST for short, is a trust. Ignore the Delaware. They're drafted under Delaware law. That's the only thing it means. But the DST could and does own real estate all over the country. And typically it either owns one property or owns multiple properties, like a portfolio. These trusts are typically anywhere from, say, $30-40 million in total size to up to $250 million in total size. So they own very large assets. And it really brings the opportunity to invest in institutional quality property down to the layperson, the average investor. So we might, you and I might identify and purchase a 1/4% interest, a 0.25% interest in the DST. And that means we own 0.25% of everything inside that Delaware Statutory Trust. So if it's one property or a portfolio of properties, we own a piece of all of those. And the investor actually will choose the DST that they want to invest in. So they're going to choose the DST. They're going to know what properties are in that DST, and they can decide whether they want that DST or a different DST. And when they're working with the securities broker who sells these, they can say, look, I don't want anything that is retail. I don't really want anything that's office. I really want something that is multifamily. I want something that's storage facilities. I want something that's student housing. I mean, they could choose the asset class they really want to invest in. They could also say, I don't want any DSTs that are in New York or California because of the valuations are so high. They might say, I want a DST in Florida because there's no taxes in Florida, or a DST in Texas because there's no taxes in Texas. So again, the investor chooses what they're going to invest in. And they 1031 exchange into the Delaware Statutory Trust. The minimum investment is only $100,000. So in a lot of cases, clients can buy a whole bunch of these if they want, or they could buy just one. Depends on what's right for them. And again, they own whatever's inside that. So it's a great strategy. It's another tool in your toolbox. A lot of times when we're working with agents, the first thing they'll say is, well, wait a minute, it's sold as a security, so I can't get paid on it. And that's true. But I would look at it as another tool in your toolbox, because I also get a lot of agents who call and say, I got this client and they're refusing to list property with me because they don't know what to reinvest in. They're afraid that if they sell, they can't find replacement properties, et cetera. So this is another tool to help you get a listing. And here's really the four common uses of a Delaware statutory trust. First one is a primary investment strategy, and that's really what they target. Those are folks who have had rental properties usually for years and they're done. They go, I'm done with real estate, I'm done with tenants, I'm done with repairs and maintenance, and whatever their issue is, and they want to get out of real estate. But then they find out if they sell real estate, sell their portfolio, they're going to have a huge tax consequence. So that's what the DST targets is folks who want to get out of real estate but don't want to get killed on taxes. They can sell their property, 1031 exchange into a DST. The DST does all the property management, the asset management, et cetera. The investor just gets a monthly distribution, generally by a direct deposit. So that's really the target. But a lot of people don't want that as a primary investment strategy. Completely understand that. Probably the most common use is a backup investment strategy. And this is where it could be a great tool for you. You may get somebody who says just that, I'm not going to list the property because I don't have a clue what I'm going to reinvest in. Or what if I can't find something? So in that case, you could say, let's go out and find property. Let's identify property one and property two as properties that you and your client go out and find. And maybe property or designation number three will be a DST. The intent is not to buy the DST, but the DST is a backup identification just in case the other two fall out. And generally, if you identify a DST when it first comes out, it's usually available for 3 to 4 months. So it'll be there if you need it, but that's part of the conversation with the securities broker. The third area is we'll have clients who sell, do a 1031 exchange, they're in the middle of it, and they go to buy replacement property and they find out for different reasons they can't qualify for financing. It may be they just don't qualify because interest rates are so high they can't cover the payments. It might be that they're self-employed or retired, they don't have earned income, whatever it might be. With the DST, most of them have built-in financing or built-in debt. And if the investor buys, let's say, a 0.25% interest in the DST, they get 0.25% of that debt, and it qualifies as debt replacement. But they don't have to sign on the debt. It's non-recourse. If something goes wrong, the lender cannot come after the investor. So really positive there. And the fourth area is we'll have clients who say, I found property, I'm going to buy property, but I'm going to have $100,000, $200,000, $300,000 left over. Can't really do anything with that. In that case, they could buy a DST and absorb whatever excess cash is left. So that's really kind of the uses for the DST. Those are the four that we see the most often. So with that, a quick question. We have another question is, if an owner creates a Delaware Statutory Trust of his own property and trades it for another DST units, is it a like-kind exchange? Yes, absolutely. So if you're a beneficial owner of a Delaware Statutory Trust, then that means you own real estate. It's a disregarded entity. It's a pass-through entity. It's treated as if you are the real owner for tax purposes. So if you transfer your beneficial interest to someone, that's considered a transfer of real estate for tax purposes. So whether you sell it or you just swap DST beneficial interest, all of those can be structured as a 1031 exchange transaction. That would certainly qualify with no problem. Another question was with the DST, how fast can they close? Great question. So if you are working with a securities broker, you've already got it lined up and you're ready to go. And then for some reason you say, let's go the DST route. If you've got it picked out, then literally if the sale closes today, we receive the funds probably tomorrow from escrow. You could close on the purchase of that DST tomorrow or the day after. As soon as you close on the DST, the client starts to earn income on the property. So great question there too. Another question is, can you explain how debt on a DST property interest is a way to avoid debt relief? Sorry, just did that one. So yep, great question. I beat you to that one. So that's kind of a DST in a nutshell. Again, look at it as another tool in your toolbox. There's lots of tools. You just need to keep them at kind of back of your mind. And when you've got a client who has a challenge, you can use these different tools to help solve the problem. So let's go a little further on non-like-kind property, because like-kind is like-kind, but non-like-kind is also important to talk about. So anything that is personal use, primary residence, second home, vacation homes, anything with a lot of personal use probably is not going to qualify for 1031 exchange treatment. However, you could certainly change your usage. So with a primary residence, you can move out, convert it to investment property. In this case, you probably want to rent it for at least a year. I would even go 2 years just to show you did have the intent to convert it, et cetera. And then you qualify for 1031 exchange treatment. So even if it doesn't qualify for 1031 exchange treatment today, it can qualify in the future by just changing the personal use to investment use and documenting that. Documentation is key, as you saw in those developer examples. They didn't change the documentation, so it still looked like they were holding for sale. Other things this gets a little complicated, so I'm just going to kind of to give you an overview here and then kind of go from there. A lot of investors will go together. So you might set up an LLC and have 2 or 3, 4, 5 investors. And then they buy real estate as investment property, rental property, or business use and whatnot. And then down the road, they decide to sell the property and they call and say, we each want to do a 1031 exchange, but we all want to go different directions. That's where it gets complicated. If the LLC with multiple members, that's treated as a partnership for tax purposes. If they're going to stay together and they're going to sell together and reinvest together, then the partnership, the LLC partnership, would actually do the 1031 exchange transaction. That's nice and clean. But when the underlying members or partners of the LLC want to go different directions, that's where it gets difficult. They have to remember they don't own real estate. They own a membership interest or a partnership interest in the entity, and the entity as a partnership actually owns the real estate. Now, there are all sorts of potential solutions here. So we have to kind of sit down with you and your client, walk through the goals and objectives, find out exactly what kind of an entity it is, and see if there's a way to address the problem. There's exceptions to this issue, and that is anything that's disregarded. So we mentioned the Delaware Statutory Trust is disregarded. So you could sell as an individual and buy as a DST. It still qualifies. If the LLC is a single member LLC and disregarded, it will also qualify. You could sell as a DST, or sorry, you could sell as an individual and then buy under a disregarded entity that's an LLC, or you could sell as an LLC and buy as an individual. Probably the most common example there is you own the property either in a single member LLC that's disregarded, or you own it in your living trust, which is also a disregarded entity. You sell those, you're doing a 1031 exchange, and we set up the exchange under the LLC or under the trust. You go to buy replacement property, and the lender says, we're not going to lend to an LLC or a trust. You have to take title in your individual name. Well, if those entities are disregarded, you could buy in your individual name. That's treated as if it's the same taxpayer. So that's the real requirement. It has to be the same taxpayer all the way through. What you'll see on the internet a lot is it has to be the same exact legal title. That is not correct. It has to be the exact same taxpayer, and that's the critical part. Let's go to the next one. So deadlines. I think a lot of people already know this, but I'll mention it just in case. So we always have a few folks who've never done exchanges before. So when the sale of your property closes today, you trigger your deadline. So it's the closing, or it's when the legal ownership transfers from the seller to the buyer. So if escrow closes today, buyer gets ownership today, tomorrow is day number 1. And you've got exactly 45 calendar days to identify what you're going to buy. That's the most stressful part, most difficult part of the 1031 exchange transaction. And then after the 45 days, you have an additional 135 days to complete the exchange for a total of 180 days. So be very careful. It's not 45 plus 180. It's 45 plus an additional 135 days for a total of 180 days. That's critical. You want to make sure you help your clients make sure they stay focused, don't miss the deadlines. It's amazing how many clients completely forget. We remind clients 3 different times, twice by email and once by phone call, and some of them still miss the deadline. So be very careful, because that'll blow your whole thing, your whole exchange. When they're identifying property during that 45-day window, they're going to typically use the 3 property rule in most cases. So that means you can identify up to, but not more than 3 properties. But if you're going to identify or want to acquire more than 3 properties, and in a lot of cases, that'll be a Delaware Statutory Trust or a tenants in common property, then you're probably going to look at the 200% rule. So let's say you sell a property for $1 million. The 200% limit would be twice that, so $2 million. In that case, you can identify up to $2 million in total value It doesn't matter how many properties you identify. And it's either or. So you either follow under the 3 property rule or you fall under the 200% rule. And you don't have to make this decision until midnight of the 45th day. So you got 45 days to figure out how you want to do this, what you're going to identify, and which rule you're going to fall under. Now, in some cases, and I'll use a lady as an example, a few months ago, she identified 40 single family residential properties. We looked at the ID form, we called her, said, look, you've identified 40, it's way over 3 properties, and it's way over your 200% limit. And she goes, it's not a problem. I'm going to buy all 40. It's one contract, one sale, one closing, one seller. And she goes, I'm either buying all of it or none of it if it falls through. So in this case, she closed on all 40 single families. So she falls under the 95%, 95% exception, which means she closed on at least 95% of the value that she identified. So be very specific. You have to identify the actual address. If there's no address, it could be an APN number. If there's no APN number, it might be a legal description. If there's no legal description, then it might be the meets and bounds description. But you have to identify the specific property. If your client's going to be looking at buying a condo, it cannot be identified the condo complex. It has to be the specific condominium they're going to buy. So whether it be an address or a unit number or what have you. And the identification needs to go to the qualified intermediary. Okay, next one is there's a lot of misinformation out there on this slide as well. We get a lot of folks who call up and think all they have to do is reinvest their equity, their cash that comes out of the sale, or reinvest their profit, their taxable gain, and neither one is correct. It's not the bottom level, it's not your cash, it's not your equity or your taxable gain or profit. It's the top level. So let's say, again, you sell a property for $1 million. You are allowed to subtract your closing costs, not all of them, but your routine selling expenses. So your broker's commission, title, escrow, documentary transfer tax, recording fees, things like that. So on $1 million sale, your net sale price after those costs is about $960, give or take. $960 would be the magic number. So they have to have the intent to reinvest. They have to trade equal or up in value, meaning buy one or more replacement properties equal or greater than about $960 in that example. And all of the cash equity needs to be reinvested into the replacement property. One of the things you'll see on the internet is things like you have to trade equal or up in value. You have to replace your debt. You have to reinvest your equity. Well, that's true for the most part because most investors want to defer all of their taxes. But it's not completely true. You can do a partial exchange, and we'll talk about that in a minute. So going back to, you have to trade equal or up in value if you want to defer all your taxes. You have to reinvest all your equity if you want to defer all your taxes. And typically, if there's debt, you replace what debt was paid off on the sale of your relinquished property with new debt, a new loan on the purchase of your replacement property. Or you could put out-of-pocket cash in. So some people say, I don't want any more debt. I'm going to buy the new replacement property of equal or greater value, and I'm going to put all cash into the purchase. So cash can replace debt that was paid off. So that certainly works. So the rule there is you can always put more cash in, but if you pull cash out, you're probably going to trigger a taxable event. So going down further, partial 1031 exchanges are okay. You know, it's the old adage that real estate investors are real estate rich and cash poor. So maybe they do a 1031 exchange and maybe they pull some cash out because they need some cash in their savings account or something. That is okay. That will not hurt the 1031 exchange transaction, but they will likely pay some taxes on the amount they pull out because the cash they pulled out was not reinvested. Therefore, it's probably taxable. Now, that means it's a taxable event from the 1031 exchange perspective, but they actually may not pay taxes depending on their tax return. They may have losses that would carry forward and offset those. So always talk to your tax advisor first to see if you're going to have, if you have a partial exchange, are you going to have to pay taxes? A lot of clients will do a partial exchange, trade down slightly, pull a little bit of cash out, and they still don't pay tax. So it just depends on your situation. But again, you can pull cash out. Some people want to trade down in value because they want less debt. That's okay. But if you don't replace the debt completely, you're not fully reinvested, it may trigger a tax consequence. So again, partial exchanges are okay, but you may trigger a tax consequence. So again, visit with your tax advisor so you know exactly what you're looking at. And this is our last slide, just to kind of sum up a couple transactions that are a little more complicated. And then from there, I'll wrap it up with any questions, et cetera. So with that, this is kind of special tax planning. So the first one is an example. This is one of my favorite examples. And this goes back a number of years, but we had a client, husband and wife. They bought a home in La Jolla. They lived there as their primary residence for 42 years. They were having health issues, wanted to go back east with their family, et cetera, but they kept telling people, I can't do that because I've got an $8 million gain on my property. If I sell, I'm going to get killed in taxes. Well, the IRS has a specific ruling that covers that, where you can convert your primary residence to investment property, and then at that point, rent it. We'll talk more about the example. And then when you sell, if you do it right, you can still qualify for the $500,000 tax-free exclusion, the 121 exclusion, and you could also qualify for a 1031 exchange. So in their case, what we said, look, you've got an $8 million gain. Move out, go back east. Convert the property to investment property, so rent it. We said, you've been living here for 42 years. So to be conservative, let's have you rent it for 2 years. 2 years straddles 3 tax periods or 3 tax returns. And then you've got 1 more year that you can use to sell the property. And as long as you close escrow on the sale before that 1 year is up, then you qualify for both. You can still say you've lived in the property for 2 out of the last 5 years. And you can also say, I've also rented the property for the last 2 years. So therefore you qualify for the $500,000 tax-free exchange, tax-free exclusion, and you qualify for the 1031 exchange. So that's exactly what they did. They got 500,000 tax-free. You can do whatever you want to do with that 500,000. The other 7.5 million of gain was deferred through a 1031 exchange where they bought investment property. So win-win situation for all of the parties there. That could be a great way for you guys to farm for business, because you can target, get a list of homeowners in the high net worth areas that have owned the property for, say, over 5 years or over 10 years as a primary residence, and then send out a mailer to say, did you know you could do this, and convert that to a rental property, et cetera. Second example is where clients have a property, they're going to sell it, they start a 1031 exchange. So let's say they sell a property for $1 million. They're in the middle of a forward 1031 exchange. They find their replacement property, and maybe the replacement property is $5 million. And they say, geez, I'm selling a property for $1 million. I'm buying for $5 million. I wish I had sold a second property to help pay for the new property. Well, there's 2 options. One is try to sell a second property quickly. And if you can get it into the same 1031 exchange, you could do 1 forward 1031 exchange. In a lot of cases, if it doesn't sell quickly, then we combine 2 1031 exchanges. So you sell for $1 million, you buy and you close escrow on the $5 million purchase. We're going to allocate $1 million of that purchase to wrap up the forward exchange. They sold for $1 million and bought for $1 million. And we're going to use the rest of the $4 million purchase to start a reverse 1031 exchange. Now they have a new time period to go out and sell a second property to help pay for that property. It's a little complicated, but it's definitely doable. We do it all the time. We just need to plan for it and kind of walk down all the deadlines and due dates, et cetera. So there's all sorts of ways to combine 1031 exchanges to help. The last one is, folks will tell you can't do this, and that is, we call it an advanced improvement 1031 exchange. It's really I think the industry more likely calls it a leasehold improvement 1031 exchange. That means you are building, doing an improvement exchange, and you're building on property that you already own. There is risk with those. We can walk through that if you're interested in that. The IRS has issued 3 private letter rulings that let the taxpayer do exactly that. So it is possible, but those those are not those are not cookie cutter deals. They're very much custom deals. So there's more costs involved, a lot of moving parts. There are some risks, but it just shows you what you can potentially do with a 1031 exchange transaction. And that is a quick whirlwind tour on 1031 exchanges. And I'll check for other questions here real quick. We're 5 minutes over the cutoff. So anybody who wants to hang out and ask questions, I'm happy to stay. So we have a couple questions here. They kind of revolve around DSTs. Do we prepare DSTs on behalf of a sponsor? No, we don't get involved with either setting up DSTs or preparing DSTs or accounting for DSTs. We're just the 1031 exchange qualified intermediary. And then we work with the securities brokers. We work with the sponsors, so we can help, guide people through those if they have any questions, et cetera. We can introduce you to whoever you need to meet to kind of get those questions answered. A final question so far is, does Exeter act as a trustor of a delayed sales trust? And I think that's the deferred sales trust, which they specifically named that because they can use the same acronym DST. And no, we don't act as trustee or trustor of the deferred sales trust. In fact, be very careful with deferred sales trusts. Um, kind of a quick summary there. The California Franchise Tax Board in 2019 put qualified intermediaries on notice that if we use a deferred sales trust to quote unquote save a failed 1031 exchange, the qualified intermediary will be liable for failure to withhold on the failed 1031 exchange. And California has specifically said the deferred sales trust will not defer state income taxes. Then in 2023, the IRS put monetized installment sales, which is similar, different but similar, on what they call the Dirty Dozen list. The Dirty Dozen list is trying to communicate to taxpayers the 12 riskiest scams and or risky structures, if you will, for that particular year. And so for 2023, they put monetized installment sales on the Dirty Dozen list. And you can Google that and you can read up on it. But when they mentioned the monetized installment sales, they said and or other similarly structured transactions. So that really involves those type of structures that are drafted under Section 453, which includes the installment sale note, the self-directed installment sale note, the deferred sales trust, things like that. So with those, if you're interested, be very careful. Talk to your legal and tax counsel. That is critical to make sure you avoid getting into hot water. And then the IRS has since come out, I think it was 2024, if I remember correctly. And if you do any of those types of structures, it's now what they call a listed transaction, which means you have to disclose that you did one on your tax return. And any financial advisor or any type of advisor who materially participates in any of those type of structures has to also disclose that they were involved with one. So be very careful with any types of those tax deferred structures that are drafted under Section 453. And if I think at that point, there's all the questions have been answered. If you have any other questions, go ahead and post them, and I will take the questions as we go here. I'll wait just a couple minutes to see if there's anything else. And it looks like that's probably all of the questions we've got there. Let me back up real quick, go to my QR code. So if you have any information, any questions, any need some educational materials, everything we put out is educational. We don't do any salesy stuff. So with this, it's the guide to 1031 exchanges is about 30 pages. There's also some quick reference guides out there it's a threefold that kind of quickly get you up to speed on 45 days, 180 days, et cetera. All of that's free. Just download it from that QR code. Or if you want, you just email us or call us, and we'd be happy to email it out to you. We're always consultative. So if you have any questions, feel free to reach out to us. If you're working with another QI, happy to chat, because a lot of times we get people who say, I can't seem to get an answer, a straight answer, or anything like that. So happy to chat. We do have one more question, and that is there a secondary market for DSTs, which are Delaware Statutory Trusts? Great question. There have been a number of attempts to create a secondary market over the years. They have, for the most part, failed. There are a couple companies who try to do that today, but it just hasn't taken off. So the secondary market for DSTs is really you notify the securities broker. The securities broker is going to notify the sponsor of the DST. The sponsor is then going to notify all the investors, their investors, and say, hey, we've got somebody who wants to get out of the DST. Generally, when they want to get out, it's because there's a bankruptcy or a divorce or medical needs or something like that. So there's an urgency where they have to get out. And the challenge is they put it out to bid, and all of the investors, I've only seen this happen 3 or 4 times, but all the investors bid at a discount. So you'll probably take a loss if you sell your DST before it goes full cycle. And actually, I never talked about the full cycle. So DSTs have a holding period. The average holding period is 4 to 7 years. So it's a short-term hold. So even if you go in as a backup strategy, and I've done this once where the properties we identified in our personal 1031 exchange just didn't work out. We tried, we couldn't reach an agreement with the seller. So fortunately, the third identified property was a DST. We ended up buying the DST, and that saved us from paying a ton of taxes. We are now, let's see, 4.5 years into that DST. That DST will likely go full cycle in the next, say, 2 years ish. And when that happens, then we can, when they sell, the sponsor will say, we're going to sell the property. That's considered a sale of real estate. In our case, we're going to, work with our agent, and we're going to go out and find our own property and buy our own property. So we only use it as a backup ID at that point. But you could certainly use it, as I said, for those other 3 uses. But anytime the DST sponsor sells the property, that's considered a sale of any other real estate. And you could exchange into another DST. You can exchange out of DSTs into something else you go out and find. You've got complete flexibility. So a lot of options there. Any other questions? Okay, I think that's a wrap then. Um, Next question is, are you aware of an UPREIT owned by a publicly traded REIT? Um, Not that I'm aware of. Typically, what happens is an investor will do a 1031 exchange into an UPREIT. The UPREIT is generally not publicly traded. The UPREIT uses the strategy to build up the REIT. And then once the REIT hits a certain size, the REIT will either sell out to another REIT, so the UPREIT goes away, or the UPREIT itself could actually go public. And then, so either way, it usually ends up in a public scenario, but not always. So it just depends on the sponsor, what their goals and objectives are there. Okay, and that's all the answers or questions, sorry. So happy to chat. If you want, just shoot me an email, give me a phone call. Happy to answer any questions you might have. Happy to be consultative. So thank you so much. Thanks for joining us today, and look forward to working with you in the future. Take care, everybody.